The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Arabi Legamedi. These are your headlines. Crude prices sink on a report Israel will not target Iranian oil or nuclear facilities, while OPEC once again cuts its forecast on demand. We'll hear from the IEA later this morning at 9 BST. The S&P 500 notches its 46th record close of the year as market darling Nvidia hits a fresh all-time high, putting it on the cusp of overtaking Apple as the world's most valuable company.
And European automakers look to tackle competition from China here at the Paris Motor Show. Xpeng President Brian Gu tells CNBC the Chinese EV maker is looking beyond EU import tariffs.
What happened with tariff is something that we had to deal with. It puts a lot of pressure on our business model, but as a long-term focused brand, I think we need to find every possible way to address and make ourselves competitive.
UK Prime Minister Keir Starmer vowing to slash red tape in a bid to drive up investment as BNY CEO Robin Vince tells CNBC a steady approach from the government is key.
They've laid out a vision and directionally it's pro-growth, which obviously is attractive to investment and for companies like ours to want to be part of that. But it is going to be important that it's consistent over time.
We start off the show this morning with numbers rolling across the line from Ericsson and the latest set of results. The company was battling some challenging conditions but doing what it could in its own ability to control execution. So what we've seen on the numbers now on the third quarter, EPS at 1.14 Swedish krona, the third quarter adjusted gross margin 46.3%, EBITDA hitting the tape at 6.2 billion. The company's gross margin at 45.6, net income 3.88 billion. The company, as we take a look at this adjusted EBIT of 7.3 billion versus an estimate seen lower than that at 5.7. So it is a clear beat on that number. So that is sailing above expectations in terms of net sales at 61.8 billion. This is also above estimate. So again, a better outing is what we're seeing on some of these numbers. The company is saying restructuring charges have amounted to minus 1.6 billion, mainly related to redundancy activities. The IPR revenue is expected to reach at least 13 billion in 2024. Signs that overall market is stabilizing with North America. And that is key because don't forget, this is a company that went through a lot of cycles, deep investments in 5G in North America. That then rolled over. That market started to dwindle and we saw it bouncing back in the second quarter. So the big question today was whether we saw some of that momentum continuing. So stabilization is the message here. Now that tone around the 5G cycle, that has been very similar with India, where you've seen stepped up investment in India, but they've also started to cool. So the line here is that sales growth was offset by materially lower sales in market area, Southeast Asia, Oceania and India. So again, India proving somewhat of a trouble spot in the latest quarter.
So is the AT&T deal also beginning to bear some fruit perhaps then with them? Because if things are stabilizing somewhat in North America, they'll begin to see a lot more contracts and a lot more deliverables out of that AT&T deal. But it is a slow churn for them as well. And so slightly better than anticipated, particularly on their top line as well, that net sales figure. As we've seen. So
I don't know. I mean, the conditions have been challenging for a lot of the telecommunications operators. And let's face it, AI is not bringing any extra revenue for them. So in terms of more deep investments required in these networks, where is that investment coming from and what does it do to returns at this stage? So I think many of these operators are pulling back. So the question is whether there is a foothold in the United States markets for them or whether that money's already been spent.
And that's why they have these restructuring charges as well, which are still related to redundancy activities. So, yeah, we'll speak to the CEO about it, right?
Yeah, and we're looking for a line on Vonage here too, which has been a problem for the company. We'll be joined by the CEO of Ericsson, Boyek, and will be joining us at 6:45 BST. Don't miss that conversation.
Now, Israeli Prime Minister Benjamin Netanyahu reportedly told US President Joe Biden he will target military facilities in Iran. That's rather than oil and nuclear targets. That's according to the Washington Post, which cited sources familiar with the matter. It comes amid speculation that Netanyahu agreed to a limited counterstrike that will not impact the upcoming US presidential elections. The Israeli government said it will make final decisions based on, quote, national interest. OPEC has also lowered its outlook for global oil demand this and next year, marking its third consecutive downward revision. The oil-producing group now expecting demand to rise by 1.93 million barrels per day this year, down 100,000 amid a weaker picture in China and moves towards cleaner fuels. Dan Murphy joining us then to get a hold of this one a little bit more. Dan, just two parts, of course, to this conversation. The Israeli Prime Minister saying that, of course, he will favor perhaps military sites as opposed to nuclear and oil targets in the Middle East. And then on the other side, then, of course, having the revisions then put forward by OPEC when it comes to oil demand.
That's exactly right. You've said it. Good morning, Arabile. So oil prices pulling back in the order of about 3% in the Asia session. We are now well below that 80 USD handle on Brent, and WTI also slipping here. And this comes in particular off the back of this latest report here after we saw reports suggesting that Israel may indeed not strike Iranian oil targets, somewhat tempering the supply disruption concern that has been keeping prices at a premium here and, of course, contributing to the downward pressure right now as well. Now, of course, what Israel says it's going to do and what Israel does are two very important things to be assessing here moving forward. Israel yet to make a final decision on how it's going to react and respond to that Iranian missile strike. So we'll have to continue to watch and wait to see what happens next in the region. But as you say, the other bear factor contributing to the pullback that we're seeing in oil right now is another downgrade from OPEC on the outlook for demand here. It's cut its forecast to 1.93 million barrels per day. That's down from the previous estimate of 2.03 million barrels per day. And importantly, OPEC also cut its 2025 demand outlook as well. China, of course, accounting for the bulk of the 2024 downgrade. Things in China are not as good as the OPEC ministers originally expected them to be. Chinese growth is now forecast at 580,000 barrels per day. That's down from 650,000 barrels per day, so a 100,000 barrel revision. And this also comes after we saw Chinese oil imports falling for a fifth consecutive month in that new trade data that was released yesterday, again adding to the bear case for oil here. Of course, a lack of stimulus from China announced at the weekend, and the suggestion that perhaps policymakers in China are long on intent here but short on detail when it comes to future stimulus measures has also not just caused global equities to react and respond, but oil to respond as well. Of course, China being the world's largest crude consumer. At the same time, it's important to look at what all of this is going to mean from a policy perspective moving forward as well. It certainly raises the stakes for OPEC's December 1 meeting, and the weaker demand outlook also causes somewhat of a dilemma for OPEC, which is caught between cutting production and maintaining market share moving forward. So a lot of moving parts in the oil patch, and this is likely to impact the European equity space as we open up today as well, with oil now pulling lower in the order of about 3.5%. It's back to you.
Dan, thank you very much for that. We're going to have plenty more in the oil market with the IEA's Toril Bassoni. Don't miss that conversation, 9 o'clock BST.
So there's a lot to really unpack when it comes to the market movement stateside that we saw then yesterday. Some upward movement, particularly Dow Jones Industrial, the S&P 500, all of those hitting record highs for the S&P, 46th time this year. Why? Well, again, the likes of Nvidia managing to move a little bit higher as well than yesterday's trade. So overall, you saw 41 S&P 500 firms set to report their numbers this week. So it's all that anticipation, plus, of course, the positivity you had seen still come through from the market just last week. But again, those tech counters managing to find some gains. Just very quickly on the Dow Jones Industrial, actually there, you saw the likes of Caterpillar and Boeing actually go down, which kept a little bit of a check. on that uptick, on that upward movement then from the Dow Jones Industrial. On the other side, though, Nvidia, just make note of that because it's a 2.3% uptick then that you saw in that stock then yesterday. 2.4% it was there. Year to date, 180%, one must note. And that is, again, a lot of other players saying that they're going to need a lot more investment in the chips that Nvidia is ultimately making, pushing it higher. $3.4 trillion, pretty much the mark then for Nvidia at this time. It's also pushed up the Asia chip stocks because that's what's moved higher across the board there. You're seeing the likes of SK Hynix, who of course do make a few products as well for the likes of Nvidia and some of the other players in this market, manufacturers high bandwidth memory chips for AI applications. That is up 2.8%. TSMC there, 2.4% to the good as well. So some solid gains across some of these chips also. Onto the treasuries market here then as well. Bonds providing perhaps a little bit of lead of a different kind then, particularly out of the United States then as well. The 10-year ending at around that 4.09% mark as it currently is right now. Then it's actually gone up 42 basis points over the last 4-week period then for the 10-year note. So interestingly enough to see where that goes. Of course, more question marks around maybe pausing with these cuts or holding off on how quickly you cut then from Kashkari and Waller. We'll unpack that throughout the show. Asian markets overall here a bit mixed then in some respects. The Nikkei going up 1.25%, but 1.5% loss then for the Hang Seng. We'll unpack exactly what's moving things along then, particularly on that Asian front, because markets are moving towards that 3-month high out of Japan. Karen.
Arabile, let's push on to the economy as Minneapolis Fed President Neil Kashkari says more cuts are likely in the coming quarters as the Fed reaches the final stages of bringing inflation back to target. Fed Governor Christopher Waller echoed his remarks, saying his baseline still calls for reducing the policy rate gradually over the next year, but called for more caution amid a slew of data showing unexpected strength in the US economy and labour market.
So let's ask Joost van Lande, Senior Investment Strategist then at Van Lanschot Kempen, and just ask, Joost, did we underestimate how strong this market actually is? Because we just keep finding these records.
Yes, but I think it's not just the market, it's also the underlying economy in the US. I think two factors in the last few weeks have made a difference. One is the revision of the GDP numbers, because before the revision, we saw that consumers were spending faster than their income was growing. And you can be optimistic on consumers, that's okay. But if the income is not there, then it looks unsustainable. That has changed. Income growth is now stronger than consumption growth, which makes it more sustainable. And the second is the labor market numbers. There's also always a bit of worry about the labor markets. There are signs of cooling, but those labor market data were pretty strong. So I think those two factors for the US economy, which were reasons for concern, reasons for a growth slowdown, maybe a bit too much, that is also quite a difference. And I think that also underpinned the market strength that we see at the moment.
Yeah, that market strength, though, if one was to take a look at words or comments then even by the likes of Christopher Waller yesterday, just speaking about how future interest rate cuts will be less aggressive than the big move we saw in September. So still those cuts coming. Does that worry perhaps market because things may stay a little bit higher for a little longer than perhaps the market would maybe want then, giving a reason for some concern out of this market movement slowing for the remainder of the year and into next year?
That could be, but I think a normal pattern for markets is, and also to move in line with yields if the cycle is dominating. So if the cycle is improving, you can have a situation where equities go up and where yields go up. If it's more inflation driven, then the market is much more negatively sensitive for interest rates. And with inflation falling, we're moving into that different climate. We have seen the inflation dominance in the past year, and I think we're moving to that growth dominance. That would also imply that if growth really slows and yields start falling, that it won't save the equity market, because then there's the worry about growth. But I think what you see at the moment, that the market is able to withstand higher yields, fewer rate cuts. I mean, we think sort of a 25 basis point path going forward, maybe even skip one. The market has been able to cope with that because underlying growth is strong enough, and that is revenue growth, that is profit growth for companies, and then the market can handle it, I think.
There's a lot of reporting, there's a lot of analysis on the Fed. It's very clear that it's still important, but is it in the driver's seat? And the reason I ask this is we look at the trade yesterday, one of the big movers was in the technology world, and it was Nvidia, based on the fact that you've still got money rolling through an investment in these mega chips, and that the earnings should still be very strong from here. And when we see technology out in front, in some ways it can be a defensive arm of the market where investors just trade a long-term theme. So do you think the Fed is still on the driver's seat?
Yes, I think so. I think so. What is interesting, when they cut with 50 basis points, there was the discussion that the Fed was too late, and acknowledging it basically, and that more had to be done, maybe behind the cycle. And now we're about a month later, and we're discussing whether the Fed should maybe slow down its rate cuts. So I think the cautious approach by the Fed, and laying out quite clearly what they intend to do, is the right thing to do at the moment. And they've always said they'll be flexible. They can accelerate. They can slow down. Now the data are more strong. They may slow down, but I think they're fully aware of the situation that's going on. And if growth is stronger, then they have to cut a little less than we thought maybe a few weeks ago.
So, to my point around some of the big drivers on the markets then, what does it mean? We've also got earnings season unfolding. We're looking at a US election too. Why is technology proving one of the key areas of the market still, when just a couple of weeks ago investors were somewhat cautious about how these stocks were trading?
Yes, I think this is very much about maybe hope going into the market at some point, and then it has to be confirmed, or sometimes it's not confirmed. So then you see the big tech stocks wavering a little bit, and now we see that ongoing strong demand, and then investors are coming back and maybe a bit too positive. But I think what we also have seen over the past weeks, that the whole equity rally and also the earnings improvement is broadening out in the market a little bit. So it's not just the tech stocks carrying everything. So maybe from day to day that may be the case, but the broader picture I get is that the market is broadening, the market gains are broadening, earnings are broadening, and that is actually positive. When you think about the elections, that's highly uncertain. The outcome is uncertain. What's going to be implemented after the elections is uncertain. It's interesting that the market doesn't really react at the moment. So maybe it's a shock when we get the outcome. I think that's very hard to say.
You've seen many China cycles, and this one that is playing out, it is a crucial time as we see this prop that has been missing from the global economy. The latest overnight is that we may be talking about an additional $850 billion in special treasury bonds over 3 years to try and stimulate the economy. Are we seeing enough out of China that gives us some confidence, even if they're not going to get back to heady heights? At least it's stopping some of the rot that's been setting into the Chinese economy.
If you look at the headlines, I would say yes, because it's not every single measure, but the fact that they're taking so many measures, announcing so many measures at the moment, that underlines a sense of urgency that is at the Chinese authorities. The 850 billion, I think we have to see how much that is actually investment into the economy, or just sort of a debt swap from the local governments to the central government. If that is the case, then it won't have much of an impact. So I think that's also the disappointment slightly that you saw in the market, because it's a very large number. But it looks like the authorities are determined to get to the 5%. I think the big question mark is still, is it going to be sort of investment or consumption driven? We would want to see the latter. Making it more sustainable, because if you push up investment, you won't address basically the deflation risk that is in the economy. So there are two uncertainties: where's the money going to in terms of investment consumption, and whether it's just a debt swap or not. So I think that is still the uncertainty that we see there.
Yeah, you pointed to such an interesting part there, just whether it's consumption-led or investment-led. We'll certainly see then, yes. Thank you so much for the time this morning. Really appreciate it. Joost van Linders is the senior investment strategist then at Van Lanschot Kempen.
It's always the opposite way. Everyone's always arguing for more investment, spending rather than consumption.
And with this market, it's the other way around, right? Because here, that's exactly the conversation that actually has been had in the UK.
And you spent all day yesterday.
And actually, Mario Draghi was even speaking about it not so long ago, actually, in his paper. He said a lot more investment needs to go into Europe, but not happening as much as it is, for example, happening in China. So,
I mean, we've had this COVID spending wave that we've kept following from products to services and travel. But now we want to see the investment money in some of these Western 100%. Economies instead.
Well, does it bring about debt? That's the big question as well, because a total global public debt is set to top $100 trillion for the first time this year. That's according to the IMF's latest fiscal monitor, which says debt is expected to hit 93% of global GDP by the end of the year and near 100% by the end of the decade. This comes ahead of the fund's joint meeting with the World Bank in Washington next week. In the report, the fund signaled out the US and China, saying stronger fiscal tightening is needed in systematically important countries where debt is not projected to stabilize.
Same to offenders. I'm going to be talking about this a lot at the conference next week in Washington, but it is going to be a fascinating one. Meantime, China could reportedly raise around $850 billion in new debt over 3 years in a bid to jumpstart its flagging economy. That's according to Caixin, which cites multiple sources with knowledge of the matter and says the money will partly be used to help local governments resolve their off-the-books debt. This as Bloomberg reports the banks in the world's second largest economy could cut rates on 300 trillion yuan worth of deposits as soon as this week in a bid to avoid a profit squeeze amid a slew of stimulus measures. Banks considering the move reportedly include China Construction Bank and the Industrial and Commercial Bank of China.
Ahead on the show, losing power? French President Emmanuel Macron opening up the Paris Motor Show as the European auto sector charges ahead, first into brewing trade war with China. We're live on the ground in Paris. Coming up next. Plus, AI fever, that's beginning to fuel. There's a renewed rally in Nvidia stock as the chipmaker inches closer to unseating Apple as the world's most valuable company. Plus, Ericsson posting a third quarter beat as it says the overall market is actually beginning to stabilize with sales growth in North America, but declines unfortunately elsewhere, especially in India. We'll unpack with a first on CNBC conversation, the company CEO Boria Elcom. That's happening in just a bit, coming up at 6:45 BST. Now, French President Emmanuel Macron officially opened the Paris Motor Show, pledging support for the auto sector and saying Europe must have a united strategy to support the EV transition. He also backed the EU's tariffs on Chinese-made EVs, saying they were defending fairness.
This is a difficult time because you have the contraction of the European market and very strong competition from the Chinese. And so I think it's necessary at times like these, first of all, to protect ourselves in order to create level playing fields. When certain Chinese manufacturers benefit from subsidies, then it's normal that we impose tariffs to compensate for it. If not, we don't have a level playing field.
Charlotte is live from the Paris Motor Show. Then, Charlotte, I mean, judging by the voting that went on for the approval of those Chinese EVs, we certainly have a whole lot of disparaging votes and people in different directions and how they see the actual argument. So not everybody carries the same thoughts as President Macron.
Well, certainly France was one of the strongest voices in favor of those new EU tariffs for Chinese imports into the bloc. And look, Germany was certainly against it. And we know that the French brands, for example, are less exposed to the Chinese market. They don't sell, Renault doesn't sell in China. So maybe they were less worried about that. And like the German automakers actually sell their cars in China, worried there would be some retaliation. Well, we've seen some retaliation already from China with those tariffs imposed on brandy coming from Europe. And most brandy coming from Europe, well, is French cognac. So So there you go. You have a bit of an answer there of what this could be looking forward. But we know some negotiations are continuing, and certainly here those European automakers try to fend off some of that tough competition from those Chinese EV makers coming into Europe. And one of them is Xpeng, the Chinese EV maker. They are starting to expand in Europe. They started in France, in Germany. They will start in Spain, Portugal, and the UK in the last quarter of this year. But of course, this expansion is happening as we see these tariffs coming into play there. So I had a chance to catch up with Brian Gu, the vice chair and president of Xpeng, and asked him whether those new tariffs coming were changing their business plans.
Our plan for Europe is a very long-term one. We see Europe as a very important market for us. And also we see this market will have to take time to develop. So we do have the patience and the long-term commitment. What happened with tariff is something that we had to deal with. It puts a lot of pressure on our business model, but as a long-term focused brand, I think we need to find every possible way to address and make ourselves competitive. So that's something that we had to do as a company.
Does that mean that you will reflect and impact some of those tariffs onto the prices of your cars that you sell in Europe?
Well, I think it will take a number of areas for us to figure out what's the best strategy. That will include what type of models we introduce to Europe. That will involve what type of business models we will have to with our partners, and also potentially looking at pricing as well. So there's a number of areas we are looking at, examine, try to optimize. But our belief is still try to produce the most competitive product for European customers.
And that was Brian Gu, the president of Xpeng. And, asked him whether the company was considering then manufacturing here in Europe to avoid some of these tariffs, and say, look, they have to take everything into consideration. And if they are thinking about coming into Europe long term, then that's the kind of measures that they will have to take. So very interesting to hear that there. But look, it's a company that's been pushing into the kind of premium segment of EV cars back home in China. They push into the premium end of it. And of course, it's a very, very tough competition in that market there. Price war is very aggressive as well. They delivered a record number of cars in September in China, and they have very successful Mona 03 model, M03, which competes with the Tesla Model 3 there, and that's what they've been winning. They also launched a new sedan car that is selling under 15,000 euros, and they had just the pre-orders there in China, and they had 30,000 pre-orders, so they are doing well. And yet they're still not profitable. That's interesting. They're improving on their gross margins. They're winning market share, but they're not making a profit just yet. As I said, they're working aggressively in getting market share to eventually make a profit, but at the moment, they're still posting loss.
Charlotte, thank you very much for bringing us that story. Meantime, elsewhere in the sector, Hyundai Motor India has sold shares worth $989 million to institutional investors, including BlackRock, Fidelity and the government of Singapore, as it prepares for a $3.3 billion IPO that is set to be the country's largest ever listing. Parent company Hyundai will sell up to 17.5% of its stake in the IPO, which will value the car maker at as much as $19 billion. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.